Do you remember when everyone was talking about high interest rates? Well, the tide is turning. With signs of a slowing economy and a weakening labor market, the Federal Reserve is widely expected to lower rates soon, hopefully. But why would policymakers do that to begin with? And what happens, more importantly, to your money when they do? Welcome back. I'm Nida with Asset Management Group, and today we're unpacking what happens when interest rates move down, from mortgages and student loans to stocks and small business financing. I'll answer 5 key questions so you can make smarter decisions as rates fall. Now, before we jump right in, I want you to take some time to like this video, share it, but by all means make sure that you're subscribed to our channel so you get more educational content just like this. Question number 1, why would the Federal Reserve drop interest rates? The U.S. Federal Reserve has a dual mandate: keep prices stable and maximize employment. When the economy slows and unemployment rises while inflation moderates, the Fed uses rate cuts to encourage borrowing and spending. As the St. Louis Fed explains, if the economy weakens and employment falls short of the Fed's goals, the Federal Open Market Committee may lower its policy rate. Lower rates decrease borrowing costs, stimulate consumer spending and business investment, and boost hiring. The Fed also watches inflation. Lowering rates make loans cheaper, but can stoke prices too. So policymakers usually cut only when inflation is near or below their target. If you take a close look at some of the Fed's notes, you'll find that reducing the federal funds rate during a downturn lowers borrowing costs and is going to encourage households and businesses to spend more money, just like you and I. If rates are lower, we'll consider maybe financing a new vehicle or purchasing a car, or maybe doing a remodel on the house that we've been waiting to do. Lower rates stimulate spending. Question number 2, what data points push the Feds toward a rate cut? Look, there's several indicators that influence rate cut decisions. One of them is a weakening labor market. And in August, the pace of job growth slowed sharply. There's a lot of discussion about that, but that's what the report said. And if you look at some of the analysis, you'll find that the deteriorating labor market has changed the Fed's calculus and will likely push policymakers to cut rates. Economists expect the Fed to shift from worrying about inflation to focusing on labor weakness. Falling inflation with tariffs still nudging prices, inflation remains above this 2% Fed target, but core inflation has eased toward 3%. If the CPI, Consumer Price Index, reports show further moderation, then by all means the Fed is going to gain room to cut. Slow growth, negative quarterly GDP also plays a factor. Contracting, manufacturing, and service sector data or falling consumer confidence signal that tight policy may be choking off demand. Look, these conditions combine with rising unemployment were catalysts for past Fed rate cuts, which is why we think we are moving into a decreasing rate environment. And one other would be just financial stress, market volatility, and widening credit spreads or international crisis can also prompt the Fed to lower rates to stabilize the financial system. Now, question number 3, how does a rate drop benefit me as a borrower? You and I, like most Americans, we tend to borrow money. Whether we have a business and we're trying to borrow to grow a business, or purchase a vehicle, we have kids that are growing up and we need student loans. At the end of the day, that's typically how we have a relationship with interest rates. And so to answer that question, falling rates can simply lower borrowing costs. Home loans and refinancing become an option. Lower rates bring down mortgage payments, particularly for adjustable rate loans. Now, U.S. Bank notes that rate cuts could help bring mortgage rates lower. If mortgage rates decline and income stays healthy, housing demand may rebound and affordability may improve, which would be a huge help. Now, for existing homeowners with rates above current levels, refinancing into a lower fixed rate can save thousands over the lifetime of the loan. Don't go jump and do it right out of the gate just because you know the rate has dropped. There's a lot more factors that goes into whether or not that makes sense for you and your family. Now, credit cards and personal loans, variable rate debts adjust with a billing cycle. So, credit card, you're going to see a drop in your interest expense, but our hope is that you just pay it off and get it behind you anyway. Northwest Bank reports that After a rate cut, credit card and adjustable loan rates typically drop within 1 or 2 billing cycles. Pretty quick turnaround. Now this makes borrowing cheaper for big purchases and frees up cash for savings or investing. Auto financing, when rates fall, auto loan payments may decline slightly, especially on new loans. So new loans, you're going to be in a good spot. Extending loan terms can lower monthly payments further, but remember it increases the total interest cost. It may not be the best thing for you to do. So let me give you a practical tip. Evaluate all variable rate debts and consider refinancing to fixed rate, mortgages or student loans, if you can lower the rate enough to justify the closing costs and if you plan to stay in the home long enough to break even. Use the savings to build your emergency fund or increase retirement contributions. More importantly, just make sure you're making the right decision and you've analyzed all the elements and factors that will go into ensuring that that is true for you. Now, question number 4. How does a drop in rates benefit me as a stock market investor? Rate cuts, they often boost equity markets. U.S. bank analysts note that when the Fed lowers interest rates from high levels, it often signals a positive outlook for equities. Expectations of 2 small rate cuts later in 2025 have already been supported by stocks and pulled bond yields toward the lower end of their range, meaning that in some sense it's already priced in to the performance of equities at this point. Now, let me explain why. Lower discount rates, the value future corporate earnings is discounted at the prevailing interest rate. When rates fall, those future earnings are worth more, supporting stock valuations. Cheaper borrowing for companies? Well, businesses can refinance debt or fund growth at lower rates, lifting profit margins. U.S. banks note that favorable interest rate trends tend to help income-oriented sectors such as utilities, energy, and real estate programs. All of those are going to perform better. And tech and growth stocks, they may also rebound as investors favor riskier assets over lower yielding bonds. If you look at just kind of where we are with the tech space, yes, tech stocks are priced heavy, but there's also a amount of money that's needed to continue to invest into the development of technology for these companies. Cheaper borrowing for companies. Now, businesses can refinance debt or fund growth at lower rates, lifting profit margins. U.S. Bank notes that favorable interest rates help income-oriented sectors such as utilities, energy, and real estate, and all of those sectors are going to perform well. Now, tech and growth stocks may also rebound as investors favor riskier assets over lower yielding fixed income. Matter of fact, if you look at the tech sector right now, obviously we know that it's pushed a lot of the equity performance or the S&P 500. That said, they're still re-innovating and investing a ton of money back into their operation and their model to be able to continue to advance what they can do with technology. Well, lower interest rates is going to support that initiative, especially if they're doing any of that on leverage. Now, less attractive bond yields? Well, falling rates reduce yields on treasuries and money market funds, meaning that the downside is your high interest savings account that you've enjoyed and your money market that's been paying a reasonable rate may not do that any longer. So this could nudge investors towards stocks in search of higher returns. Now, let me give you a caution. A rate cut is often a response to economic weakness, which can hurt corporate earnings. Stay diversified and match your portfolio to your risk tolerance and ultimately your plan. Hopefully you have one. Question number 5. How does a rate drop benefit me as a business owner? This is huge. Not just tax laws, but just rate drop in general. What does that do? Well, for entrepreneurs like us, lower rates can unlock growth opportunities. Reduce financing costs, as we already mentioned. The Small Business Resource explains that a Fed rate cut usually leads to lower rates on business credit cards, variable rate loans, and SBA loans, saving money for businesses that carry debt. When rates drop, more of each payment goes toward principal rather than interest. So you're lifting the total value of the balance sheet. So this is going to free cash flow for inventory, hiring, and marketing. Once again, pushing small business and getting small business to a place where they can compete. Now, refinancing and expansion. NAV notes that if your business loan rate comes down, it may be a smart time to refinance or shop for a better finance loan or contract. Lower rates also make major purchases much more feasible, like equipment or real estate. And in fact, the Big Beautiful Bill does also support that initiative as well, giving you the ability to carry on major depreciation and expenses to reduce tax liabilities. And if you have to finance it, that's okay. You can still depreciate and finance, putting more money back in your pocket to continue to grow your business. Northwest Bank highlights that businesses, they may decide to expand operations or acquire competitors more so in a season like this, just because rates are moving and it's giving them the ability to borrow money at a lower price. It's going to boost consumer demand. Rate cuts can increase disposable income for households, just like you and me. Now, you don't need to go take that disposable income that might be freed up and go take out another loan. Use it to benefit your future and your family. A report I read by Northwest Bank says that lower debts often lead to more spending, especially here in America, which is not always the key. But that does directly fuel economic activity and may help your business's top line. But what's important is that it also benefits your household bottom line. However, because the Fed typically cuts in response to slowing growth, the bounce, if you will, may simply help keep you on track rather than ignite a boom. Competitive landscape, cheap credit can lower barriers to entry. Northwest Bank, the article that I was referencing, cautions that lower rates may lead to a flurry of startups and expansions, increasing competition and altering supply chains. Use this period to strengthen your market position and invest efficiently and create improvements in your business. And just a few final thoughts. A Fed rate cut isn't just a headline. It filters all the way through credit cards, the stock market, your business finances. Policymakers cut rates when the economy slows. We know that. Unemployment is rising, using cheaper money to encourage spending, like a weakening job market, moderating inflation, and slowing GDP growth are all pushing the Fed to ease policy, and we're expecting it. For borrowers, as we mentioned, a rate drop can reduce monthly payments and open refinancing opportunities. Investors like yourself may see a lift in stock valuations as companies enjoy lower financing costs. Business owners can refinance, fund growth more cheaply, and capitalize on revived consumer demand. I think the most important thing is that you remember your financial life is living and breathing. There are many controllable elements to which you hold the keys, but there are several outside elements that are far from your control. Your responsibility is to ensure that what you're currently doing adapts to the economic environment as well as the changes in your life. If rates do drop as we expect and continue to drop in the future, you're going to experience, hopefully, some pressure relief in your cash flow. Take a moment at that time to sit back, revisit your plan, and make sure that you're taking advantage of the freed up cash flow to support your family's initiative. Don't spring up and go purchase an unnecessary item. Take out a new loan. Don't even go refinance yet. Pause. Sit. Be patient, make sure you speak to a professional, speak to your advisor if you have one, and just make sure that your family and your plan is on the path in which you desire, heading into a direction that you desire to go. If you enjoyed this video, make sure you like it, share it, and by all means, if you have any questions, take time to drop them here in the feed. We'll look at them and answer every single one of them. And if you need any help, Asset Management Group is always here to walk you through this journey side by side. See you next time.